Hi, this is the sixth complete comprehensive example. In this example sum, we will deal with the situation where the fixed capital method which is being followed has to be converted into the fluctuating capital method. So conversion of fixed capital method to fluctuating capital method. We'll go to the example sum. Example sum. A and B are partners sharing profits and losses equally. Their balance sheet as at 31st March 2019 is given below. To the left of the screen we have the balance sheet. On the right, additional information. C is admitted as a partner for 1/4 share on 1st April 2019 under the following terms. First point, C is to introduce rupees 2,50,000 as capital. Second point, goodwill is agreed to be nil. Third point, it is found that the creditors included a sum of rupees 15,000 which was not to be paid. Fourth point, workmen compensation claim of rupees 20,000 is to be accounted. Fifth point, provision for doubtful debts is to be 10% of debtors. Sixth point, it was decided to henceforth follow fluctuating capital accounts method. Seventh point, bills accepted of rupees 40,000 issued by creditors were not recorded in the books. Eighth and final point, A provides rupees 1 lakh loan to the business carrying interest at 12% per annum. We are asked to prepare the revaluation account, the partner's current account, partner's capital accounts and the balance sheet of the new firm. Now, when we look at the balance sheet on the left of the screen, we have the balances of capital accounts which is given for A and B, as well as the balances of the current accounts for A and B. So we know that the firm is right now currently following the fixed capital method. The sixth point tells us that the firm is interested in henceforth following the fluctuating capital accounts method. So our approach would be this. We will first prepare the revaluation account and transfer the gain or loss to the partners' current accounts A and B's. Then we will prepare the partners' current accounts and we will transfer the balance of the partners' current accounts to the partners' capital accounts. That way the partners' current account balances will be closed and we will have only balances in the partners' capital accounts. So that will be our approach to solving the problem. As far as goodwill treatment is concerned, the second point says goodwill is agreed to be nil. So we do not have any goodwill treatment. The firm doesn't enjoy any goodwill. So there will not be any goodwill treatment. So let's begin with the solution. We will prepare the revaluation account first, then the partners' current accounts, then transfer the balance of the current accounts to the capital accounts, complete the partners' capital accounts and then go on to the balance sheet. Solution. Revaluation. Account. Left side debit side, right side credit side. Particulars. Rupees. Particulars. Rupees. The first point is about the capital of C. The second point, goodwill. Third point says that the creditors included a sum of rupees 15,000 which was not to be paid. Decrease in liability of creditors. So by creditors account 15,000 rupees. Next point, fourth point, workman compensation claim of rupees 20,000 is to be accounted. There is no reserve at all, so we need to record an unrecorded liability. So to workmen compensation claim account, amount 20,000 rupees. The fifth point, provision for doubtful debts is to be 10% of debtors. The debtors amount is 1,50,000. 10% comes to 15,000 rupees. Existing provision is 10,000. So we need to debit the revaluation for the difference. So to provision for doubtful debts account 5,000 rupees. The sixth point, they say that henceforth they will follow the fluctuating capital method. The seventh point, bills accepted of rupees 40,000 issued by creditors were not recorded in the books. The journal entry for this particular transaction is creditors account debit to bills payable, which means we need to decrease the amount from creditors and add the amount to the bills payable balance. This will not affect the revaluation account, and so we will ignore it for now. The last point, A provides rupees 1 lakh loan to the business. That again will not affect the revaluation account. The greater total is on the debit side, 25,000 rupees. By loss on revaluation, transferred to partners current accounts. A, B, the total loss on revaluation 10,000 rupees. Profit sharing ratio is equal 1:1. So 5,000 rupees against A and 5,000 rupees against partner B. So this is a revaluation account which has been prepared by us. Next, let's prepare the partners' current accounts. Left side debit side, right side credit side. Particulars. A, partner B, partner C. Particulars. Partner A, partner B and partner C. We'll begin by bringing down the balance of the current accounts. By balance brought down 80,000 rupees in the case of A and 60,000 rupees in the case of B. C does not have any balance. We can avoid the column for C altogether if desired. Let's transfer the loss on revaluation to revaluation account. 5,000 loss for A, 5,000 loss for B. There are no reserves to be distributed, nor are there any accumulated profits or losses or fictitious assets. Goodwill is nil, so all the entries are done. We will transfer the balance to the partner's capital account. Greater total 80,000 rupees for partner A to partners capital accounts, 75,000 rupees. Case of B, greater total 60,000 rupees, and we need to transfer 55,000 rupees to B's capital account. So this is the partner's current accounts. Next, let's open the partner's capital accounts. Partners capital accounts. Left side debit side, right side credit side. We have particulars. Partner A, partner B and partner C, and again particulars, partner A, partner B and partner C. We'll begin by bringing down the balance of the capital accounts of A and B by balance brought down. In the case of A, rupees 3 lakh, and in the case of B, rupees 2 lakh. We'll insert the capital which is brought in by partner C by bank account. C is introducing rupees 2,50,000 as this capital. Next, we'll transfer the balance of the partner's current account which we've transferred to the capital account. We'll bring it here by partner's current account. We'll refer to the partner's current account. In the case of A, it's 75,000 rupees, and in the case of B, it's 55,000 rupees. So it's 75,000 for A and 55,000 rupees in the case of B. The transactions are done. We will balance the account. To balance carried down. The case of A, 3,75,000 rupees total. Balance carried down is also 3,75,000 rupees. In the case of B, 2,55,000 rupees total. And the balance carried down is also 2,55,000 rupees. In the case of C, it's 2,50,000 rupees. Balance carried down rupees 2,50,000. So this is the partner's capital accounts. Next, we'll go to the balance sheet. Balance sheet as at 1st April 2019. Liabilities, rupees Right side assets, rupees. We'll begin with the liability side. We'll insert the balances of capital accounts. Capital accounts A, B and C. Let's check out the balances of the capital accounts. It's 3,75,000, 2,55,000 and 2,50,000. 3,75,000, 2,55,000 and 2,50,000. It totals to 8,80,000 rupees. Let's go to the next item, creditors. The opening balance is 2,60,000. As per the third point, we need to deduct 15,000 rupees which was not to be paid. And as per the seventh point, where the bills accepted by creditors rupees 40,000 was not recorded in the books, we need to deduct 40,000 also. So we are left with 2,05,000 rupees. Next item, bills payable. Opening balance is 1 lakh. We need to add the 40,000 bill payable which was accepted by the creditors. Final figure 1,40,000 rupees for bills payable. As per the fourth point, there is a workman compensation claim of rupees 20,000 to be accounted. So let's insert that also. Workman compensation claim 20,000 rupees. And finally, the eighth point where partner A is providing rupees 1 lakh as loan to the firm. A's loan 1 lakh rupees. Now as far as the interest at 12% per annum is concerned, such interest will be payable only in the next year, because right now A has given the loan, the interest will be payable only at the end of the next year. Let's insert the asset side items. Land and building. There is no change in the figure, it's 3 lakh rupees. Plant and machinery. Again, no change in the figure, it's 2 lakh rupees. Furniture and fittings. No change, 50,000 rupees. Stock. No change, 1,50,000 rupees. Debtors. 1,50,000 original figure. Less Provision for bad debts. It says that the provision for bad debts is to be 10% of debtors, which comes up to rupees 15,000. Final figure in the outer column, 1,35,000 rupees. Bills receivable. No change in figure, 60,000 rupees. Bank balance. The original balance is 1 lakh rupees. The capital which is brought in by partner C is 2,50,000 rupees. There was no treatment for goodwill, and the loan which is provided by partner A is 1 lakh rupees. So we have totally bank balance as 4,50,000 rupees. So all the items are over. I will remove the split and we'll check if the balance sheet is tallying. This is the balance sheet that is prepared by us. The liability side totals to 13,45,000 rupees. Asset side also tallies with the liability side, 13,45,000 rupees. Let's look at all the accounts again. This is the revaluation account where we got a loss of 10,000 and divided between partner A and B in 1:1 ratio. Next, we prepared the partner's current accounts, and since we need to follow the fluctuating capital method, we transferred the balance of the partner's current accounts to the capital accounts and showed it in the partner's capital accounts also, and then we balance the partner's capital accounts. And finally the balance sheet, where only the balance of capital accounts were brought down. Both the sides tally with 13,45,000 rupees.